Hello and welcome to Commodity Champions. I'm Manisha Gupta. Well, following a strong rally in the previous session, the gold prices have dipped this week on MCX and in the international markets as well. However, they continue to hold above the key $1,900 per ounce level amid the escalating Israel and Hamas conflict. The prices are up more than 5% on a week-on-week basis. The strength in US dollar index also seems to be weighing on prices right now. Meanwhile, the industrial metal prices have also seen a slump on the back of weak demand from China. To talk more about the outlook on prices for metals and energy, joining us to take this discussion forward is Ole Hansen, Head of Commodity Strategy at Saxo Bank. Ole, hi, thank you so much for joining us. I'll start with gold and silver prices first because $100 of a move in a matter of 10 days, a big run up, and we seem to be holding above $1,900 per ounce, with most banks and brokerages telling us that next year you will be looking at all-time high prices in gold yet again. How are you looking at this consolidation move and the expectation going ahead?
Well, good afternoon, Manisha. I think the main conclusion based on what's happened for the past couple of weeks is this is not a market where you should be short. We had a couple of weeks of weakness, which culminated just before that spike started on Monday, and what we saw into that sell-off was an increased short position in the gold market. So the run-up last week was primarily short covering, but also some safe haven buying. As we also mentioned, the dollar is not really showing any weakness right now. Yields are still moving higher. So at this point in time, the fact that we have rallied 5 and only corrected 1% is showing that there is an underlying strength in the market. And I think looking ahead to next year, it is still the scenario that where we are looking for peak rates in the US. Perhaps we have peaked already. And when that starts to take hold in the market, we potentially could see interest rates come down faster than what the market is currently pricing in. So we are in the camp as well that see record high prices next year.
All right. Any figure, a number that you're putting out on that one, Ole?
Numbers are always nice to throw around, but I think at this point in time, if we can see it move up towards the 2,200 level, then that would be a good year for gold. So not seeing a runaway, but at least seeing some underlying support coming into the market that will drive it up there. But also, I think the very key right now is just to watch out for the ETF holdings. They have been under pressure for many months, almost a couple of years. And holdings are at the lowest in 3.5 years. And even last week when the market rallied, we did not see a pickup in ETF demand. So asset managers are still sitting on the fence simply because the cost of financing a gold position is still too high. And that will only start to come down when the interest rate starts to come down. So that's really the key trigger, I think, for a change in the investment outlook.
Ole, how are you also looking at silver? Because while we'll, of course, talk about the overall metal as a market, but silver has been quite volatile, has not been able to hold to the highs of this year, which have been around $26 an ounce.
That's right. And silver has been struggling recently, not potentially having the same level of support that the gold market had, simply because the central bank demand is still keeping a floor, I would say, under the gold price, whereas silver is not really in demand by central banks. So silver is more left to respond to the movements in yields and the dollar, as we saw recently, where the weakness was hurting silver more than gold. But as we know with silver, if gold has a good day, then silver tends to have an even better day. And if our outlook for the prices of gold to go higher next year, then silver is likely to do probably even better than that.
How are you looking at the overall metal picture? Because the pressure here has been quite a bit. I mean, we started the year positive. We did see prices move on the higher side. But the last quarter and the start of this quarter has also been under pressure. The Chinese demand still absent. The data not really up to the mark. The strength in US dollar index. How would you look at all of this sector?
Well, the industrial metals are basically the main sector keeping the overall commodities sector into a negative performance on the year. The Bloomberg Commodity Index Industrial Metal Index is down around 15% of the year. Copper is doing reasonably well out of these metals, but it is a demand outlook that is somewhat challenged right now. And as we move to next year, some of the factors that may benefit gold may weigh on the industrial metals at the same time. We just had the LME week in London, and the signal there were quite mixed, but overall there's a little bit of a somber mood, at least for the short-term outlook, but also worries that the investment appetite right now into mining projects, it potentially be on the weak side, thereby supporting the long-term bounce that we're still looking for. But just in the short term, some of these metals, especially copper, is challenged. We are right on key support here, and that needs to hold. Otherwise, we could see some additional weakness here in the short term.
Again, all pushing you for numbers here. I mean, we have had reports suggesting that this year and next year could be of surplus for many of these metal prices, metal as a sector. Going forward, 2026-27 onwards, there is a lot of bullishness anticipated here. I mean, as you said, the kind of investment that we've seen in mining and the fact that there are investments right now, then they would only start to fructify in the next 4 or 5 years.
Yeah, basically, I think when you look at copper, with all the headwinds we had this year, with the slowdown in the Chinese property sector, even though some of the completion has still been fairly strong, then the fact that we're only down 4%, I think, does highlight the market where the underlying outlook is strong. And I think at these levels, prices are simply too low at this point in time to really attract the investment demand into the sector that is needed. So just based on that, we need a higher price. So where in terms of actual number we're going again, it's something that will be revised on a month by month basis. So I'm just basically looking for the long term prospect. We're looking at some of the mining companies, and we're looking at copper to make a new record high. I would say probably into the second half of next year.
Trading below $8,000 a ton right now, but a new high is anticipated by the end of next year. Also about the energy markets then, Ole, and this has been very, very volatile. We've seen a $70 a barrel of a low and $96 per barrel of a high in this year, which trading on the higher side of the range right now, and with the geopolitical tensions, premium working in. How are you looking at the markets? What concerns do you see coming in from Middle East? And of course, the Chinese demand concerns. It's all a big mess, isn't it?
It is a massive mess, and it's a massive difficulty in trading at it. We can see that as well on the positioning, how it's ebbing and flowing. And just into last Monday when we had that spike, that was actually quite the third biggest weekly reduction in positioning in the past 2 years. And it just highlights them. Traders are really being caught on the wrong foot or on a regular basis in this market. I think the only thing we can conclude is that OPEC wants to support the price. That basically means there is a floor in the market, and that's probably in the $80 to $85 area if you look at Brent. Where the upside can take us, nobody knows. It's all about how this conflict develops, whether we see any impact on supply from Iran. At the same time, we saw the news overnight that Venezuelan sanctions may start to be lifted, or at least eased, and that could see Venezuelan production start to pick up in the coming quarters. But in the short term, the market is tight. OPEC is ensuring that it remains tight, and that basically means it doesn't take much to add some additional flames to the rally. So a bit concerned that we could see a spike, but I think the only thing that we can conclude right now is that there is a floor, because OPEC is prepared to defend that almost at any cost.
So, Ole, a final question. Do you also see crude oil prices headed to 100? What is your best case scenario for this quarter now?
I don't think, again, in the short-term spike, yes, that's possible. But from an economic perspective, I think we're already now seeing the prices at the levels we reached last month was high enough to start having a negative impact on consumption. We're seeing that in the U.S. figures, even though there may be some technicalities involved as well. But demand is being impacted by the price rises we've seen recently, and that leads me to believe that a price spike above $100 at this point in time is unsustainable, because it will increase the recession risk, and with that, the lower demand. And OPEC can control supply, they cannot control demand.
Well, true that. Golden words. Yes, $100 is a possibility, but it won't sustain. There is the view coming in from Ole. Always a pleasure having you at CNBC India here. With that, we'll head into a short break. But coming up, we discuss the elevated crude oil prices, also impacted by the ongoing Israel and Hamas conflict, with Edward Morse, Managing Director and Global Head of Commodities at Citi. Stay tuned.